And we're going to be talking about a new era of yield in digital assets. We've got representatives from sort of CeFi and sort of hybrid approaches to providing yield products. We've got sort of leaders in DeFi lending infrastructure, and we've got the tokenization representation from Securitize. So maybe if you all could introduce yourselves. Starting with yourself.
Yeah. Hi, my name is Cyrus Fazel. I'm the proud founder and CEO of Swissborg. Always been here to bring the best from the off-chain world and let's say the DeFi world. Try and integrate the best experience within that, create great products for our loved dear Borgers. Are there any Swissborg users in the room? Raise your hand. Woo! Other people, please download the app and help yourself.
Great. Sorry. Hi, I'm Merlin, a co-founder of Morpho Labs. So I'm leading also the integration team, so basically supporting the whole Morpho ecosystem. Morpho is the second largest lending protocol out there with like 5-6 billion of active liquidity, And we're working with like Swissborg and Securitize, and what we want to do is bridging like DeFi and CeFi. And one of the biggest announcement we did recently is the Coinbase loan product that is like Coinbase integrating Morpho to provide like loans, USDC loans to their users. But I guess we can talk about this later on.
Hi, everybody. My name is Michael Sonnenshein, and I'm the Chief Operating Officer at Securitize. Securitize, for those of you who don't know, we are the largest tokenization platform in the world. We work primarily between two different spheres within the crypto space. On the one hand, we support today 10 different public blockchains, everything from Ethereum to Solana, Avalanche, you name it. And on the other side, we work with traditional asset managers that are looking to bring traditional offerings on-chain. And so underneath the Securitize umbrella, we leverage our broker-dealer, transfer agent, tokenization engine, and fund administration business to bring assets on-chain. To date, we've tokenized about $3 billion worth of securities and are probably best known for our BlackRock money market fund, BUIDL. Any BUIDL users in the audience? Maybe not. Okay, that's fine.
Here, on the panel.
Okay. I got one. We got one.
Great. I think, can everyone hear me? Yeah. We can go without that. So Michael, maybe starting with you, what's your approach to which assets, which funds you want to tokenize?
All right, I'm going to try and do this succinctly. So let me just start by saying this. I've only been at Securitize for the last 4 months. Before this, I was the Chief Executive Officer at Grayscale, crypto asset manager. And so I don't want to take credit for work that was done prior to my joining the firm. But what I will say is my fearless CEO, Carlos Domingo, has really been on this journey around tokenization over the last 7 years. And it seemingly wasn't until the last 18 months that anyone really cared about tokenization. We bear, I think, a tremendous responsibility as an organization in the space to ensure that we do not tokenize just for the sake of tokenizing. Because when you tokenize an asset, it generally has speed bumps, it's more complicated, it's more cumbersome for investors. The investor experience isn't as good as its traditional counterparts are. At least it's not yet. So if we're going to make folks go through those additional hoops, we objectively need to be offering them some other value add. Is it taking RWAs that they're investing in with us and connecting it to the world of DeFi, like Morpho, where the traditional counterpart, you can't take a private equity fund or a money market fund and connect it to Morpho, unfortunately. But in tokenized form, you can. We have to give investors the ability to perhaps earn greater yields or offer them features or attributes that their traditional counterparts aren't getting. So for example, in BUIDL, our BlackRock money market fund, investors are getting daily dividend payouts versus in traditional products, they're getting them monthly or even quarterly. So for us, we are highly scrutinizing about the asset issuers that we work with, Hamilton Lane, Apollo, KKR, BlackRock, et cetera. And from a fund perspective, we want to make sure that the funds and the types of products we're bringing on chain are done in a way where their attributes, their features actually makes sense for a tokenized world, a world that demands liquidity, transparency, frequency of valuation, et cetera, as opposed to some of the other approaches to tokenization where the assets are perhaps not as good of a fit because their valuations are stale very quickly, or the addressable market is just not there yet.
Great. And maybe a follow-up there. So who is the buyer? Who's the buyer of these tokenized assets right now? And over the next year, how do you think that will change, or the next 2 years?
Yeah, I would say candidly, some of the largest investors in these products today are not surprisingly crypto native. They already have value on chain, and it's for them diversifying from digital assets into RWAs sitting on chain as well. There are starting to be more and more TradFi buyers. I think the likes of having asset issuers like BlackRock and Apollo offering products on chain is waking up a lot of people, drawing a lot of attention for them to participate. But ultimately, it has to do with a shift, right? Today, I think most investors think about a wallet as a place primarily that they're speculating on digital assets, Bitcoin, Ethereum, et cetera. Maybe they're getting more sophisticated and moving into DeFi and other things like that. But that shift is underway where you can actually start to think about your wallet also as a home for investments. And so other assets, whether they're private funds like we're offering today, or even equities, et cetera, you're gonna start to see more assets beyond digitally native assets creep into wallets, so that investors are starting to merge what today is a brokerage account with a digital wallet. And so over time, I think you're going to see increased participation from a broader and broader group.
And as especially sort of financial institutions are able to offer wallet type products within their own existing, say, brokerage services, they would kind of be that natural next user for.
Well, they have to be, and this is where I think the crypto community has a tremendous advantage and a market opportunity to take hold of. The crypto providers and the infrastructure is going to be much faster to bring traditional assets into wallets than traditional, infrastructure is going to be to bring crypto assets into accounts, right? And so ultimately, if the goal of any of these providers is to get 100% wallet share, no pun intended, you're going to want to try and do that as quickly as you can.
Okay, Merlin, you guys have completely transformed the lending landscape in DeFi. How did you do it?
Right. I don't know if we have transformed the landscape yet. I think we have a very different approach than other in the space. What we've so if I take a look back at what we started with optimizer that were optimizing rates on Aave and Compound on those lending pools where you have a huge spread between the supply and the borrow rate. It was kind of rooted from some inefficiencies at the protocol level, and we said, hey, let's reduce that spread to zero and provide that to users. So it was basically the same experience, same risk parameters, but better yield. And this is how we started. And we worked for 2 years on top of those lending protocols, and we realized that those protocols have very deep limits and caps on what you can do with that. There can be upgrades at any moment, pausing of the protocol. There's the governance that decides on risk management decisions, while token holders are not risk managers. It's a one-size-fits-all model, etc. And all those kind of things, if you add all those things, just from our side, we needed to make sure that our protocol was still running well. And so it was adding a lot of operational costs and monitoring costs. And we realized, okay, if DeFi will welcome thousands of assets with each of them with different risk profiles, and also users you have degens, but you have also very risk-averse users, especially if we want to bring everyone on DeFi rails, then we need to find a scalable way to handle that. And we say, okay, the lending pool model does not scale that way. So we need to find a way to fix that. And this is what we did with Morpho Blue that we launched like 1 year ago, and now there's like 4 or 5 billions. But still, we think that it's not the end game yet. We are working on some cool stuff that we think that will please a lot Securitize, because when you think about like reward assets, etc., you have like many different KYCs process, many different like restrictions, many different assets, and maybe you'll end up in a situation where you have one asset for each user, each type of user or each user, and which can be super problematic for some protocols. We are thinking about this. We are anticipating that growth, and we think we'll be able to solve that. Right now, the Morpho Blue design has proved to be super useful and has opened the door to what we call risk curation, where instead of having one size fits all model, you can have like many different vaults that are managed by risk managers, and those vaults can like direct the liquidity of users to like different markets that are isolated. So you isolate the risk, but you also choose like to which market you want to be exposed to. And so if you want to target like risk-averse users, then you can create a vault depositing liquidity into blue chip markets. Else, you can deploy capital into like very risky markets to get higher yield. This is segregated. It's fine. If something bad happens on one market, does not affect the other. And this is the way you can scale to many markets, many assets, many configurations, and many type of users.
It seems like there's a big change in thinking about the distribution of the DeFi innovations, right? Like, how do you get that next user? The next user is not a DeFi degen. It's someone who maybe wants something a bit more sort of conservative, maybe a tokenized asset through a vault. You know, taking that. Yeah, maybe you want to add to that?
Yeah, no, it's just like every human is unique. And so if you really want to bring the best experience to those, you need to have like a very tailored and provide a tailored experience, which means like provide a tailored risk. Because everyone has a different risk appetite. So of course, like, there is like some overlap, fortunately, but we do think that we need to work on that aspect as an ecosystem, because else it won't scale, and we'll just like be stuck in that DeFi bubble that is just self-referential, and will never scale to those billions of users.
And with the Coinbase loans integration, where users are now able to take loans against CBBTC, or the user just sees the front end with Coinbase, you know, what's your strategy around working with centralized entities, and how do you approach that? And maybe you could share a bit more about how that relationship with Coinbase started.
Right. So I think part is Coinbase strategy that is, I think, quite clear. They want to bring like most of their users on chain, just because it's like more efficient for their users, so they can bring better yield. They can be better, more competitive versus their competitors. Also, it's reduced like their operational costs. Like, they don't need to run the thing; they just need to run the interface. That is pointing to the thing, and maybe taking a fee or something like that to generate revenue. So for fintech and centralized exchanges, etc., it's, if you get it, it's a no-brainer to move your users to the DeFi space. Also, you can get like network effect, etc., deeper liquidity. But for those kind of actors, what they care about is legal compliance, security, and also they have like a very strong reputation, and they don't want to risk that. So, and if you see that there's like 4 billion that have been hacked in the DeFi space for maybe the last 2 or 3 years, I don't know, it's just insane. So what you want to do is being able to create a product that is super safe. Like Morpho is like 600 lines of code, super simple. You read, it's an article. I mean, it's not it's code base, but that's super easy to understand for a developer. It's super safe, audited multiple times. That's for the security part. Also, you can scope the risk exposure to their users. So if you are a borrower on Morpho and you deposit like BTC as collateral or USDC, you only exposed to that market only. While on other platforms, like if you deposit your BTC, you're exposed to all the other assets because it's a lending pool, which is like something those actors are really not comfortable with because they don't know if like the X sushi or whatever will just like blow up. So that's another thing. And also on the legal compliance side, Morpho is not like is governance minimized, immutable. So there's no third party that can like interact with and change the parameters of the market or the protocol. And what does it mean is that you just own the entire stack. It's just like you are the owner of the product, which is super important if you're like a centralized exchange or a fintech actor. You don't need to rely on the DAO or whatever, that it will be like kind enough to not like do a shit in the future.
Not screw you over.
Yeah, exactly. So that's,
yeah, there's a lot of decentralized theater, but what you've built is kind of something that allows whoever the user is to create an independence in their product.
Yeah, exactly.
Cyrus.
Yes.
Yield. When we were going through the notes, you said, this is my product vision. This is what I've been building for a long time. Right. Could you tell us about what has been your approach to offering yield products to your thousands of users?
Yeah. I mean, look, we started in 2017, and the main thing was about to do an ICO and to tokenize our company, right? And then we realized a bit more difficult than that, so we launched the token, did great. But I would say the third cycle last time was about how to try to extract now, not just to buy tokens, but to get into yield, right? So we started in 2020 with the early guys, Compound, Aave, and all of that. Yield farmed a lot, did staking, went to liquid staking, now with restaking in this fourth cycle. And I think the biggest dream that Swissborg always wanted is how do you break financial freedom where people could buy the best assets? Then how do they do to get a yield on it? Also staking, again, liquid staking, restaking, yield farming, whatsoever. And how to minimize that risk. Because obviously it's always great, but a lot of people, the users, when they say like, oh, I get 3% in my bank account in Europe, and then I get 25% with Swissborg, I'm gonna go with Swissborg. But does the end user really understand the risk that's behind UST? Probably not, right? And there's still other USTs in the market. We don't need to talk about it and point the fingers, but there's a lot of shit happening in DeFi, and there's a lot of gonna blow, it's gonna happen. So that's already the biggest thing that you have to do. So obviously, why did we partner up together? Well, Aurélien that is here, he was really the contributor. I was a big Aave guy, so at first I was not really into you guys, to be honest. Why? Because Stanley helped me a lot for ICO. I helped him a lot at ICO. We were in Switzerland and all that. But then the funds were commingled, right? And then as the thing evolved, is that you're starting to take risk on different tokens that you don't really want to take the risk. And I've talked to these guys many times, is that if you're in the fund business, even if you have SPVs or any type of different hedge funds, you are segregated. And the risk has to be segregated because I just want to get a risk based on my own liquidity pool I'm bringing in. So these guys figured that out. And there was other things technically that maybe Aurélien will explain more, or you will explain that got into that. So we definitely had this big fear again of saying, okay, guys, with Swissborg, everything is always going to be as less risky as possible. We'll tell you where exactly the funds are, because if you don't know where the yield is, you know where the yield coming from? It's that you usually are the real yield, right? Machinsky and all these BlockFi guys got into these business without understanding where the yield came from, and then eventually you became the yield, right? So this was the big thing that Swissborg didn't want to go back to. There's always a lot of risk to it. So we just tried to figure out like who are the people we really like today. We work with these guys, we work with Camino as well for different reasons because it's more Solana based, it's a great platform. And we always try to think where's the best value and not go too crazy and then put different risks on essentially what you're doing. Low risk for maybe staking, basic staking, mid risk for other things, and higher risk for alpha rewards where you try to look into different pools and go on eigenlayer and things like that, where maybe you have a little bit more risks there, but at least you get a great reward from it.
Excellent. And as there's more tokenized assets that come to the market, what would your approach to be to those assets? Would you want to list those assets? See what does your user base think about these assets?
So this was the talk we just had just like literally 30 minutes ago. And I had great talks with the Fireblocks guys. And again, this has been the vision, right? You want to, who's 100% in crypto? Raise your hand. Wow, you guys are really rich. So if you don't have a lot of money, just go exposure to highest risk, because there's no point of doing money market funds if you don't have cash, to be honest. Doesn't make sense. Just go as crazy as possible and try to do as your risk profile as high as possible. Like that, you'll do 2-3x, you'll lose 50%, you'll do 2-3x again, and within 2-3 cycles, you do maybe 6-7x, right? And from 10,000, you go to hopefully at least 100,000, and you get more than that. I think so. This is where we were. I think so now, as Bitcoin, as you guys seen, that what the hit has happened on the markets, Bitcoin is still sticking. This risky assets class is not as risky as for the Bitcoin, but still risky for, let's say, the other altcoins. Now our users got a great amount of money. Some are starting as well. So how do you now go from high risk to wealth accumulation? And this is exactly the perfect timing where you want to work with credible players that offer this, let's say, a low correlation asset class that enables you to go from, okay, I get exposure and go to crazy shit, to say, like, you know what, let's just have a buffer in some money market funds, buy the dip. Let's go into maybe private equity and get a very low correlated type of asset class with crypto. Let's look on the long term. Let's go to more things that are, tokenized securities, whatever, in order to have this, I'm now not only on full risk, but I may be on a medium type of risk.
For sure.
So that's definitely, I think, so where we're heading, obviously for regulation purpose and being able to sell these different products, you need a lot of different licenses, and these are things that we were trying to figure out as well.
Right. So there's been like a big wealth creation event with a lot of crypto native users, and they're looking for other ways to sustain their wealth. But also thinking about the new users coming in, and maybe that are thinking about, or professional investors that are already buying these assets, money market funds or other things, and they're looking at the tokenized version. And you mentioned that there has to be something objectively better about the tokenized asset for these users to want to change their infrastructure, figure out how to do wallets, and then buy these assets and then offer them maybe to their clients. Could you give some more examples of how are these new tokenized assets objectively better?
Sure. So I think there's a couple things. So one, on the asset issuer side, our dear friends at BlackRock and Apollo, there's only so many family offices and so many sovereign wealth funds and so many, whatevers that are going to buy products from them, right? And so at some point, actually for them, not only does tokenizing actually help advance their efforts into the world of Web3, but it actually can become part of a broader distribution play for them, right? If there's all this newly created wealth within the crypto ecosystem that wants to stay on crypto rails and not move back onto traditional rails, this can actually help them tap into new user bases, right? So I think it's been very interesting for them. In terms of use cases and utility, one of the things that we've been doing at Securitize that is relatively new, but I think is going to be a bigger part of 2025 and beyond, is actually thinking about these tokenized securities as collateral and collateralizing them for various activities. So kind of the obvious ones, we're looking at assets like BIDL, the BlackRock money market fund that we have, and actually getting investors around the ecosystem, whether you were an investor, a trader, an OTC desk, a market maker, or now even exchanges, to think about a tokenized money market fund as collateral, right? This ecosystem has grown in the way that it has on the backs of stablecoin usage and adoption. And in the traditional world, we think about a money market fund as like, I have some cash lying around, I'll sweep it into the money market fund. We don't really think about money market funds as a collateral or as like something that can help to be the substrate for some kind of investment contract. But because in a tokenized form, it's freely movable, peer-to-peer, has the protections that come with owning a security, is backed by BlackRock, et cetera. Now people are starting to say, well, if stable coins allow me to facilitate all kinds of trades, spot trading, derivatives trading, perps, whatever it is, but it's not earning me any yield just sitting there as collateral, perhaps does it make more sense for me to be collateralizing my trades with an actual yield-bearing asset where that yield is actually being paid out to me consistently on a daily basis, and it's really, really high quality underlying collateral. And so the objective answer is like, yeah, that's really interesting. So I think you're going to start seeing the integration of tokenized treasury funds, which, today still only make up, a relatively small portion of the RWA market, but in terms of growth within RWAs, they've grown over 500% in the last year. So the growth is there, the usage is there, the adoption is there. I think stepping away from tokenized treasury funds and looking at, for instance, like our diversified credit fund that we launched with Apollo, that is becoming a really interesting use case for not just tokenization, but on the utility front. So as a high net worth investor, you may have a private banker, a Swiss private banker, who knows? And it's probably that private banker that's getting you access to something like an Apollo credit fund or something like that. Will certain banks or certain private banking platforms perhaps give you some kind of LTV against that? Probably. But it's going to be at a price that they said and with certain terms and this, that, and the other thing. On the other hand, what we're doing at Securitize is actually being innovative in allowing investors to vault these tokenized assets to be able to mint stable coins on top of them and then go loop them in DeFi, right? So think about what you may be able to do using one of these assets as a really high quality collateral, but then go into a place like Morpho, right? And so today, you might be earning 9% on that Apollo credit fund, and you're very happy with it. And for some investors, that may be enough. But for other investors who want to think about the relatively illiquid nature of it, it only has quarterly redemptions, something like that, how can you enhance your return? Well, you can actually go and use that collateral to interact with the DeFi ecosystem and earn another 10, 11% on top of it. And so these are objectively measures that certainly outweigh their traditional counterparts, but is nonetheless still, very early days.
On the stablecoin side, there's, it's yet to be seen what the legislation turns out to be, but there's also talk of yield-bearing stablecoins and whether or not they should be allowed. What's your view on that, and what do you think would happen to the money market ecosystem should yield-bearing stablecoins become a thing?
Yeah, so I don't have a true dog in this fight, so I'm not going to share like an outright opinion on it. What I will say is that I definitely do believe that tokenized treasuries are going to start and have already started challenging stablecoins, no question about it. I also think that their paths are probably more intertwined than was ever believed. So you're seeing, I'm kind of calling it stablecoin spring. I'm going to coin that one, no pun intended. But there's a lot of stable coins coming online, and people are seeing just how profitable it is to operate a stable coin. And if they can have even a tiny piece of the market compared to some of the incumbent giants, they have everything to gain and nothing to lose. And so some of the prevalent conversations being had around stable coins are transparency and reserves. And what do people want as reserves? They want to know exactly what's backing that stablecoin, and in a lot of instances, they're turning to products like we offer to be the reserve asset behind those stablecoins. So I do think their paths are starting to converge a little bit more, and you are going to see a preponderance of stablecoins on the market.
For sure. I was at a dinner yesterday with a lot of the sort of banking institutions in Europe, and I asked this question: if regulation wasn't an issue, what product would you want to launch? As in, like, if you could bring any product.
What did they tell you?
Well, there's interesting stuff around Forex and how you could tokenize different currencies and create very efficient Forex markets. And then some others that were more relevant to their specific institutions. But
yeah, I mean, this is the other part about tokenization that I think we sometimes overlook, is that the world that we all live in, this crypto world that somehow I've been living in for over a decade, it's a 24/7, 365 ecosystem. And the traditional ecosystem that I used to work in isn't. It's 9:30 to 4 U.S. market hours. The bond market closes for certain holidays each year, et cetera. And so what you're starting to see is advances from trading venues, exchanges to move more towards 24/7 because they're seeing that the world we live in today, the news cycle, the markets, everything is moving all the time. And tokenization is certainly accelerating some of that because investors may need liquidity at 2 o'clock in the morning on a Saturday or whatever it may be. So there's a whole other, I think, kind of good use case around tokenization around making markets even more connected and unlocking liquidity on basically a perpetual basis.
I'll jump on that one too.
Please.
It's maybe less financially driven, but more emotionally driven. I think we still are very emotionally driven. For those who know, our Series A, after our ICO in 2022, just when FTX collapsed, we needed some cash. Not for the bad reasons, just because we needed to hire more people and get to do our Series A.
Was it a weekend?
No.
Okay.
No, it was not bad. We didn't get any connection to the sexes. We were always DeFi, so we were happy about that. But long story short, we did our Series A, and we got 17,000 shareholders in the company to raise like $23 million within a short amount of time. Worst timing, but best community to do that. And I think from what we said is that eventually our natural step would be to do a Series B or just to tokenize eventually our company because it makes sense. And getting back to what we've done and what I think the future remains and what we've asked to our million users is what are things that they get the most excited, and not that anything that you guys are doing are not exciting. Just to make things very clear, I think it's extremely exciting. And same to you, as you know, because we
definitely talk after.
Yeah. We already do a lot of cool stuff together with loans. But there's one thing that I think people are very excited is how to get a piece of what is their big dream. And if you're invested in SpaceX, if you're invested in all these companies that are unlisted today, or any football club whatsoever, Paris Saint-Germain fan club here, raise your hand. There's only 2 people. There's no French people or what? 3 people. It's cool to have a jersey, right? But it would be even freaking cooler to be a shareholder of Paris Saint-Germain and be able to say it's your partner, and then whenever they make money, they make money. And I think that for me is one of the big part of tokenization that will bring at least retail masses to buy big games and everything. And is to get more than just maybe a token or an NFT, is to be really an owner of those companies. And with that, get some cool other stuff with it, of course. So 100% think that private companies could be a big way forward into tokenization, and a lot of people could get an aspect to it. And there's already a few cool companies that are trying to do that, and I hope we will get into that eventually.
Is that on the cards, tokenizing private equity?
Certainly. I mean, we can tokenize virtually anything, but I think to your earlier question, it's what's a good candidate for tokenization, right? This type of model where it's a combination of stakeholder engagement, loyalty, things like that. If it's a better way to interact with your stakeholders or users, or you're starting to disrupt some of those models, then sure, there's tons of use cases for folks that want to have a better, more direct connectivity with the folks that are supporting them.
Merlin, what are you most excited about for Morpho, but also the broader crypto ecosystem in, say, the next year?
Right. Good question. First, I want to come back to what I think you say that at the very beginning is tokenizing. We should not tokenize everything if there's no use case for it. And at Morpho, we are happy to provide that use case. You have I think most of the tokenization that have happened so far were just demonstrating that we can do it. And now we have the kind of infra and the playbook that can be reproduced at scale now. But there's still this missing piece, which is providing use case for those tokenized assets to be used. And I think the protocols, DeFi was not ready for that until Morpho. And with Morpho, what we want to do is basically being the backbone of finance on the lending side, like providing the loan infra, on-chain loan infra, and we really think that it will provide like a lot of use cases for those tokenized assets. And I think for the next year, and the thing that we are thinking and currently like building, I think will unlock a lot of cool use cases for those assets. I can't really talk much about it, but
Sure you can.
but we want to really unlock what's the power of that and let people borrow against their tokenized money market funds, and like every asset, like you were talking about like a PSG. I would love to see that as collateral on Morpho. The problem right now is like it's too complex. You need to create a market. There's liquidity fragmentation, etc. We do think that there is a way to break that liquidity fragmentation and being able to kind of like match like the supply and the demands, but at scale for thousands of assets with like many more constraints, different KYC, different like whatever. And we are working on this, and we think that we'll maybe the first to provide that in the market.
It seems like a lot of this liquidity fragmentation comes from, as you said, the KYC identity challenge.
Yeah, it's just that any jurisdiction, any countries, many assets are different, etc. All have their rules, and like they must be compliant to like different rules, etc. Maybe a user can be compliant to maybe 90% of those. Some are just compliant to 10% of those. But how do you express that? How do you say, hey, I agree to like take all those kind of offers whenever they pop in the market? And right now you can't do that, because you need to create a market for this specific rule, another market for this specific rule. It is super challenging, because if you have like 100 different rules, you have like 100 different markets. And each like users must like decide on which market they want maybe to deposit their liquidity, which is like a pain in the ass when you have like thousands of markets or maybe millions in 5 or 10 years. And how do you handle that? Like for now, there's no solution in the market, but this is a challenge that we'll face, and we're already facing.
Okay. Final thoughts, Michael. What are you most excited about?
I thought you were going to ask me for a price prediction. Thank God. What am I most excited about? You know, I have to say, I know I'm in Paris, and I should be thankful for that, but I do have a pretty US-centric view of the crypto market, given that I'm based in New York and our company is based in the US. And I will just say, having been in crypto as long as I have and having fought as many regulatory battles as I have in crypto, I'm very excited about the way that crypto is being treated by US regulators at the moment. I don't want to be overly optimistic because it's still very early days. We're only a couple weeks into this. But I will say, having spent a little bit of time in Washington, it is definitively, I now have a firsthand experience that it is markedly different than it was. And I do believe there is a genuine interest in advancing crypto in the US. Does that bode well for a business like ours? Certainly. Do I think it bodes well on a global level? It absolutely does. And the reason is that when it comes to financial regulation, while yes, there have been advancements in other geographies, different pockets around the world around crypto, by and large, a lot of the financial regulation around the world does end up pointing back to the US market. So I'm optimistic.
Excellent. On that note, thank you so much to our panelists.